Welcome to the TechExits Podcast. In today's Investors Corner, we take a deep dive into where tech investors are putting their money, exploring market trends, founder challenges, and what it really takes to navigate the complex world of tech M&A. In this episode, we're speaking with Daniel Ibri, co-founder and managing partner of Mindset Ventures. With over a decade of investment experience and a portfolio spanning SaaS, AI, fintech, and cybersecurity, Daniel has guided numerous companies through the exit process and witnessed firsthand the emotional and financial complexities that arise when founders and investors don't see eye to eye. Today, we'll hear Daniel's insights on the current tech M&A landscape, as well as his optimistic outlook for the coming years and his advice for founders building for the long haul. This is an unfiltered conversation about the realities of venture capital, exit strategies, and why thinking like a marathon runner, not a sprinter, is essential in today's market. And let's begin. Hello, Daniel. Thanks for joining us. To kick things off, can you tell the listeners about Mindset Ventures?
Of course, yeah. So Mindset's been around for almost 10 years now. We invest in the United States and Israel mainly in early stage B2B software startups. So it's pretty agnostic in terms of sector. We did a lot in like SaaS and AI and fintech, cybersecurity, a little bit in health. But usually it's like B2B enterprise focused companies and software based in these geographies that I mentioned, and usually around the Series A stage. So it can go anywhere like late C to early Series B, but especially when companies already have some traction, already have a team in place, already have some initial customers, and they are pre-growth. That's where we usually invest in.
Thank you, Daniel. As you know, the Quorum Group is our platinum sponsor for the WFS. Recently, they just released a mid-year report showing a 21% increase in venture-backed exits in the first half of 2025. From your VC perspective, what's fueling the surge?
I think actually the base is not great because last year was definitely not the greatest, right? I think there was a diminishing tech, fundraising, exits, growth, etc. the past years. I think now we're starting to see some movement back to the market this year, and hopefully next year will be better. I think there are so many companies that are taking the opportunity that cost of capital has gone high to acquire earlier stage startups. Also, some startups that were struggling to raise money because it became very hard in the past years. They're trying to be sold to strategic. So there's an increase in M&A. There's not necessarily a good increase, meaning big companies doing big exits with great companies. Sometimes it's more opportunistically, I think. But now hopefully the IPO market will start to rebound, and interest rates globally will start going down. So we'll see more excitement in the tech market back, hopefully.
On the same topic, how does this environment compare to previous exit waves that you've seen?
I think there was a boom back in the very post-pandemic world, right after the pandemic, with all the excitement in AI, like very low interest rates globally, lots of money moving to tech, and IPO market booming. So there was a big frenzy there and lots of exits, which was great in one side, but on the other side, lots of assets were overvalued. So you see now this big correction in the market and stocks going down and all that stuff that scare a lot of investors. Especially the ones that invested pre-IPO on the height of the curve, those crazy valuations. And now I think we're back to kind of back to normal. I think the market is rebuilding and in different terms, in more reasonable terms, reasonable multiples, reasonable valuations, growth expectations, and all that. So I think it will be a positive cycle, but we need to really engage in that cycle. I think we're still a little bit far from it. We're still trying to recover from the craziness and then the big drop. It was all very fast. I grew very fast, dropped very fast. Now we're trying to recover and rebuild.
We know the VCs are involved in more than just raising money. So if a company on your portfolio is looking for an exit, how do you help them get prepared? And what's Mindset Ventures' role in the process?
That's a very good question. So I think, first of all, is to try to help them understand if an exit is the right path, which or who would be the ideal acquirer, who could actually acquire the company. If it's like a financial player, like a private equity firm, it's a strategic from the same market, is a competitor, right? So understanding who are the market players, it's one, and mapping those market players and then helping them establish yearly relationship, because this exit doesn't help happen in like 1 or 2 weeks. It takes a lot of time. So start to develop the relationship, meet the people, show your value, show what you have, and why you be value to this potential acquirer, and then start building the relationship. So opening these doors and establishing the relationship is one thing we're pretty active on. I think the second is making sure the company has aligned expectations on the process, the timeline, and the value, because most founders haven't gone through this path before, and then how long does it take? What do I need to prepare? How is the diligence going to look like? What my expectation in terms of like pricing, valuation? What are the deal structures? So helping them figure that out and think about how to bring an offer to a buyer, how to negotiate an offer that the buyer may present, how to find public multiples or other transactions to compare yourself with and set expectations and help you have arguments to better negotiate. So those are things we're trying to be very helpful on. And sometimes we're just helpful in saying, hey, you need some external help to drive this process. You should hire a banker or whatever firm to help you. And then we have a few in our network that we trust and that we recommend and help them engage with service providers that will do this for them.
Indeed, sometimes it's a matter of finding the right match based on the expectations of the seller. Based on your experience, are you seeing more exits happening through strategic M&A, IPOs, or secondaries?
Right now, honestly, no. I think that the market is pretty slow, to be honest. I think last year was completely slow. I think this year is a little bit better. There were some approaches to some of our portfolio companies, some strategics that wanted to buy some P firms, but I think it's still very slow compared to what it was like 2-3 years ago. So I'm really expecting that this will get better in the coming years, but I think so far it's been mostly opportunistic, like buyers and sellers mostly opportunistic in the market, but not the big exits and IPOs, etc. IPO market is starting to hopefully reopen, so I think we'll see a rebound in the coming years, but not still.
And with the market shifts and the resurgence of M&A, has it changed how you guide founders on building for acquisition versus IPO?
So I think in our portfolio we work with like B2B companies, usually serving bigger enterprises, and usually the exit path for these companies is a strategic M&A, right? In all the exits we did or almost all the exits we did so far in Mindset were through strategic acquisition to bigger players in the same markets. And I think that's the way to go for the types of companies that we invest in. So I don't think the expectation is actually change. I think for those that were actually preparing or seeking an IPO, I think it became a little bit harder. Like the bar went high and the threshold is higher. So you need to be bigger, you need to grow more, you need to be profitable, you need to maybe that positive, whatever metric. So I think for all of our companies in the portfolio that were aiming for an IPO, they just said, yeah, we're still going that route. But we know now it will take us a little bit longer because we need, first of all, the market to reopen, and we need to, now secure bigger metrics and bigger, thresholds to be able to be appealing for an IPO market. It's not as easy as it was a few years back when whatever IPO had a pretty good bounce on the first, second day of trade. Now it's a little bit harder.
What's one exit you were involved in recently that taught you something new about founder strategy or buyer behavior?
I think, it's one important thing about the exits, right, is when is to have a very good alignment between the buyers, the sellers, but also the sellers and the shareholders of the sellers or the investors, because usually expectations differ. So what I've seen a few times that is a little bit challenging is like, you have a buyer, you get to an early stage company and you say, I'm going to buy your company for, 100 million, right? And then investors say, yeah, but I invested at 40 million or 50 million. So it's like 2x my money. Okay, it's good, but this company is great. And usually the companies that get early inbound proposals for acquisitions are the ones that go better, right? Of course. So they're the ones that the players go there and just say, hey, I should buy this quick. Otherwise, they're going to grow and become too expensive. So the best ones are the ones that are more appealing. So are the ones that people try to buy early. And for us investors, we know we're selling cheap because those are the best companies. Like we want them to say, no, don't sell now, just keep growing, keep moving faster, and you're gonna sell later on in a few years for much more. But sometimes for the founders, depending on the profile of the founders, the expectations, they just look at the check and say, yeah, I'm going to put like $20 million, $30 million in my pocket. It's very good amount of money. I can retire on that. Why am I going to keep struggling and, uh, working like crazy for another 5, 6, 7 years to do 3, 4, 5x more? Doesn't matter. I prefer just to, be safe, take this money, provide for my family and all that stuff. So that usually generates a very important disalignment where founders want to exit because for them the money is life changing, but for investors, no. So having these conversations early on, aligning expectations, etc., is something really important. Otherwise, you get to a conflict, and then to get out of it, it's pretty challenging.
There are always challenges when aligning perspectives. How do you navigate misalignment between founders and VCs on exit timing or valuation? And how do you handle those situations when they come up?
That's a very, very difficult topic. I think, first of all, it's you need to be very aligned, very communicative, very transparent from day one. But eventually you get there, right? And then you need to really understand what's the financial / risk appetite / timing for investors and for founders, and find the mechanics to align that. Uh, in a sense that, for instance, sometimes there's the other side of the situation that I mentioned is like, the company doesn't have a clear, path forward. There's not much to do, and then there's a potential acquisition offer, and then the founder does the math, and because of the liquidation stack, says, yeah, all these investors are getting money, but there's probably nothing left for me. So, I don't care about selling. I'll just keep working forever on this thing. And then for the investors, it's terrible because, yeah, just give me my money back or whatever. But the founder doesn't have an incentive. So in that case, you need to really create an incentive. Just carve out a piece of the exit for the founders, create some financial incentives for them to sell the company. You need to, sometimes it's not just following protocol, but sometimes it's like creating new mechanics to really align incentives on the path forward, or to give incentives or to take out incentives for them to sell very early on, if that's what happens. The amount of money, the risk, and the timing is very different between founders and investors, and it's natural that sometimes expectations won't be fully aligned.
Markets are always evolving and changing. Which sectors or technologies are you most excited about right now, and why?
Yeah, so we're still looking a lot into cybersecurity, I think, especially in Israel, and there's a lot happening there, and there's a whole new challenge of cyber now with AI, right? And lots of different cyber challenges with AI in several aspects. So cyber is an area that we're pretty active on, and we're also looking to anything that's AI related. I think everything's AI related these days, so it's like crazy not to say that, but how is actually um, AI generating value, and what generates value inside AI? Because there's so much buzz around it, so many things AI, but not necessarily all things are proprietary or new or generating value or whatever. There's so many cool things that don't generate value to anyone, right? So we're trying to understand like what is exclusive, what has barrier, what is difficult to copy, what generates actual value for the customers, how can we differentiate there, either on the infrastructure side, on the development side, on the adoption side for big companies, big industries. So we're trying to look like, several derivatives of AI and submissions of AI, and where to, place our bets there, because definitely there's a big opportunity there, but with care, and also still looking into cyber a lot and a little bit of fintech.
So, to hear some final insights for our listeners, we've talked about the pace of exits this first half of the year and how they've been increasing. Do you think this pace will continue through the rest of the year? Any advice that you'd like to give to founders that want to jump into this wave?
Yeah, so I think the markets will get better, right? They're starting to get better. I think the IPO window is starting to reopen. We're starting to see some excitement. I think we'll see more exits, more M&As, and more IPOs in the coming years. I think sometime last year the market, especially if interest rates, especially in the US, start decreasing. I think there'll be a new excitement going to the stock market, so that will push a little bit more for the IPOs and the exits. Cost of capital will decrease. So I think the moment is still very, very difficult, very challenging, as it was in the past years. but the perspective for the coming years is much more positive. So I'm optimistic. And I'd say like this is a game that takes time and resilience. And we've been through the cycles, right? And for someone who's doing this for like I don't know 15 years that I am, you've gone through the cycles. There's cycles where everybody's making money, everybody's happy, everybody's growing, and there's cycles where everybody is like sad and crying, companies going bankrupt, and nobody can raise and exit. So it's part of the game. It's part of the game of being an entrepreneur, being a VC. You need to really aim for the long run and not just look micro into the cycles, because cycles will pass. There'll be hypes again, there'll be lows again. I'm sure about it. We don't know when, but I'm sure there will. So you just need to, live through that and survive through the downturns and take advantage of the good times and, aim for long run and know that this is a 8 to 12 year story that you're building. It's not something that, this is illusion that entrepreneurs say, hey, I'm going to start my own company. I'm going to become a unicorn and become a billionaire in 2 years. Like this doesn't happen, right? So, setting expectations correctly, not to frustrate yourself. It's very important.
Thank you, Daniel, for your wonderful insights. I'm sure that your outstanding experience will inspire our listeners and help other entrepreneurs understand the perspective of investors on M&A.
Of course, my pleasure to contribute.
Thank you for joining us today. Are you considering selling your tech company? Head over to quorumgroup.com, our tech exit sponsor. If you'd like to learn more about selling your tech company, join us at one of our Tech M&A Masterclass events. Attendees of the Tech M&A Masterclass will gain practical knowledge on how to achieve the maximum valuation for their company gained through expert-guided workshops, hands-on exercises, and M&A case studies. Our next Tech M&A Masterclass will be September 24th through 25th at the Wynn Las Vegas. Hope to see you there. Head over to WFS.com for more details. We'll see you again for the next episode.